original. And I'm in love with the money. So today I have with me Abby, and we're going to talk about debt, credit, and insurance, a dual approach to financial security. And Adi is a chartered accountant in both India and Canada. He has over 25 years of experience and he is now a fractional CFO. His career included being a CFO with some of the biggest companies, including Tata and PepsiCo. And now his business is focused on serving small and medium-sized businesses with their building out their financial resilience. I'll have him add some more to his introduction.
Hi everyone, Abby here. Thanks, Kadeen, to invite me to Money Matters. It really means a lot. So thanks once again. I'm really happy to be here to talk about this very interesting topic that we have on hand: debt, credit, and insurance. Right. Just a little intro about me. Further to what Kadeen said, I believe in ikigai, which is how can you put in sync your wider purpose in life with something that you are really passionate about and your strength, and use that to earn your living. And that was the single biggest motivation for me to move from, I would say, comfy corporate life to start from scratch your entrepreneurial journey. But it's worth it, right? I never wanted to have that regret of not trying something that my heart wanted to me to do, right? So that is what is my story. And I like to say less is more and do more with less. I repeat, less is more and do more with less. That's my motto in my company and my YouTube channel, which is Money and Mind. So have a control over money, and like Cardine says, money matters, but while having the peace of mind. So that's the dual approach as well. Yeah, so over to you, Cardine, and let's get started.
All right. So, as Adi said, we are entrepreneurs, both of us. And tonight we're aiming to help other entrepreneurs, small business owners tackle certain issues, including debt, credit, and insurance. So, with the objective of helping them to become even more financially strong and resilient. All right. So, the first question, I'm going to direct these first questions to Adi. What are the most common credit related mistakes you see your clients make? And then tell us how they could avoid them.
Sure. And before I get to the common mistakes, I would like to bust some myths and provide some kind of just to a broader context to the issue of debt, right? So the first one point to remember is called debt snowball effect. Like if you see a hill which is full of snow, when the snowball starts to roll down from the top, it seems very small, but gradually it builds the momentum, and it becomes bigger in size. So that's also the story about debt, right? So it's very important to tackle small debts one at a time so that you don't let them become a big snowball, right? So that's one lesson. The second one I wanted to talk about is credit scores are like your GPAs that you get in school, right? So what is that? A higher score opens up more opportunities for you. Both, if you are a good student, yes, there are more universities that will accept you. It will open up more job opportunities. Similarly, a higher credit score opens lot many doors in terms of getting credit, in terms of buying things that you want. But there is one catch where you can rebuild your credit score sooner, whereas it may not be so easy in case of a GPA, right? You have to retake the test, or it might be very challenging. Yeah. So uh,
I
once
do
we
like your
have,
analogies.
yeah. So the point to remember here is, you need to have strike a good balance between over or
Mhm.
under leveraging, and both can be dangerous. Yes, people think normally too much debt is bad, but and again, I don't want to get into that debate about good debt versus bad debt. But what I would like everybody to remember is the concept of opportunity cost of capital. And
Mhm.
I'll give my own example, right? When I bought my first house, as per the laws, it was between 5 to 20%, and I had about 40% saved. So I had that option of putting in 40% of the real estate, but I chose to put only 20% and took 80% debt, because debt in those days was much cheaper, right? Debt was coming at a 2% interest, and I was pretty confident of making at least 4 to 5% if those funds are with me, right? Where I have the
Mhm.
option to invest. So that is why I am saying leveraging can be good as well, if it is done appropriately. What do you think, Arden? You have anything to add here?
I do like you pointing out the opportunity cost, always evaluating the opportunity cost to make sure you're making the best financial use of the resources that you have, right? You want the most bang for your buck when it comes to return.
The another concept I would like to talk about, in business, we understand asset and liability. From a personal finance also, we use the word asset and liability much loosely, or not use, it's not very commonly understood. And here I would like, to explain to my viewers that in terms of personal finance, what is the definition of a asset in its true sense. So an asset should be something which appreciates in value over a period of time, and such
Mhm.
appreciation should be higher than the opportunity cost of capital. Sorry, it's little complex, so I will break it into parts. There are two parts to it. One, that it appreciates in value. So, say if you are buying in real estate, again, no one has a crystal ball, but chances are that it appreciates in value. But if you are
Mhm.
buying a car, the day you get the delivery from your dealer, the next day it value depreciates. So it's not
Yeah.
a true asset from that parlance, right? And the second part is the opportunity cost of capital, right? If I would not have invested, say, in real estate, and would have invested it in those funds in my business or in GICs, if I feel that is the safest option for me, which gives me 5% interest. So such appreciation in the asset should be at least more than 5% for me to not invest in GIC and to invest in real estate. So this is how I explain the word asset, in particularly in personal finance, when you are taking decision. That you're investing in jewelry. If it's a real gold, then chances are that it appreciates in value, and it will, history has proven that the gold has appreciated at a very decent thing. At times, it
Mhm.
has given return even higher than TSX or equity, right? But
Yeah.
if you are investing in a boat or yacht, right, chances are it will not appreciate. So these are something I think I would just like people to bear in mind while making
And
the,
I would like to add
yeah,
I'd like to add one other
right.
thing to that. Appreciation, and for me personally, I like assets that generate cash flow. So appreciation and cash flow for me would be the two important things.
Excellent. Yeah, I would
So
agree.
so as an accountant, what would you say is your role in helping your clients improve and build or rebuild their credit score?
Sure. So first, let's understand how, and again, there are two parts to it. One is in personal context and in business context. We'll address both of that. Let's first talk about from individual perspective, right? So how is credit score decided, or what is the mechanism that goes behind the scenes? There are weightages to 4 or 5 factors based on which credit score is arrived at. 35% weightage is on payment history. So basically, if you are paying on time or not. So that's the most important with the highest weightage. The second one is on credit utilization. Again, a thumb rule is if you have a credit limit of say $10,000, you should you would like to keep your credit within 30%. So your utilization, if you are able to manage within 30%, then you get good bonus, and that is gets reflected in your credit score, high credit score. The third factor is length of credit history. So again, we face a lot of immigrants face this challenge, right? When they move to
Mm-hmm.
Canada, they don't have any credit history. It takes time to build that because 15, so they start with zero on that 15%. The fourth one is new credit inquiries. Again, a lot of us know there are two types of inquiries, soft and hard. So
Mm-hmm.
soft inquiries do not impact your credit score, whereas hard inquiries, when you are borrowing, that impacts your credit score adversely as well, because if it is a kind of reflection that you are not able to manage your personal finance, and you have to take too much debt, right? So that's
Yeah.
the other point to consider.
Okay. So when you're thinking about your credit score, because of the elements that play into measuring it, how you use your credit, how much of it you use, and your timeliness with repayment, it suggests that you need to be responsible with your credit. You need
Yeah.
to be responsible with your cash management. Do you help in that regard as well?
Yeah, and again, my focus is more on corporates because and it's very interesting that how accurate financial reporting can help companies to have a good credit score, right? Like there
Mm-hmm.
are agencies, credit rating agencies like Dun and Bradstreet that are available that can that assess the credit score for even companies, right? So when you are trying to do business with companies, it's always advisable to pull their credit report. Again, there are charges for that, and Dun and Bradstreet is a reputed agency which can help. Yeah,
Mm-hmm.
so if you have a good reporting system whereby you are tracking your accounts receivable and accounts payable, you get collected, you are able to collect your receivables on time, and you are paying on time, that definitely boosts your credit score. And for that, a good financial reporting package definitely helps.
Yes, and I can give examples on both fronts. You mentioned newcomers. I remember when we first came to Canada and we tried buying a car, right? Because we were newcomers, the interest rates that were being offered to us were quite
Yeah.
high, right? And again, in my role as finance manager at a particular company where they relied significantly on credit, a review of their financial statements was very critical in getting credit and renewing those credit facilities. So I do understand what you're saying and how important it is. So
Yeah, and I would add two or three more points as well that people should remember. One is cash flow management or forecasting, right?
mhm,
Because everyone, whether an individual or business, goes through peaks and troughs, right? In case of an individual, say Christmas, you are buying a lot of gifts to your near and dear ones. So definitely your cash outflow for that month will be more. Or you have university going children, so you are paying for their tuition fees, that can be a huge dent on your cash outflow. So it's always good to predict your cash outflows for next 6 to 12 months, and take proactive action, right? Through whether you have enough investments, right? If you are investing all and parking everything in long term investments, and you have sudden those peaks, then you need to plan for that ahead of time, right?
yeah.
So there should be a short term investment lined up for those emergencies, and for which I help a lot of my clients to do the cash flow forecasting for next 12 to 18 months. It is like mission critical for businesses, and definitely useful for individuals.
And I think the same principles as you just explained apply whether or not you're an individual, being the CFO of your home, or you're the CFO of a company. You do have to manage your cash inflows and outflows so
Yeah.
that you know that you're meeting your obligations, right? You have to manage your debt in order to preserve your credit score or ensure that your balance sheet looks good. So, other ways, you do need to have good cash management. You have to manage your debt and as you said, have make sure that your the timing of your cash flows kind of mirror the timing of your obligations.
Yeah. Another tool which is very helpful is budgeting, right? So I like to say 60-20-20 rule and start with the 20%. So pay yourself 20% for savings slash investments before you are thinking of spending your paycheck, right? Pay yourself first. Second 60% is for all your must to have payments, right? Your grocery, your rent, your utilities, fuel, car, whatever is there. And then the last 20% is for any discretionary spends, right? So that's how, if you are able to have a budget, from personal finance perspective, and of course, businesses need much more sophisticated tools for budgeting, variance analysis, and I help a lot of my clients do that. There is a saying, like what gets measured gets managed. So it's very
Yeah,
important that you have those budgets and you have the KPIs, key performance indicators, and you do those variance analysis on a monthly basis, and you don't wait till the end of the year to know that, oh, I didn't invest in my RRSP and the tax saving opportunity that I had to forego, right? Or
mhm.
RESP for my children's education, because government pays 20% of that funds, which means you lost that free money opportunity. Yeah,
Yes, yeah. And I like how you broke it down with the pay yourself first. It's very important, especially for individuals. And
yeah,
just so you know, too, yes, 60% for your obligations, if you can manage that. I know in today's environment, it has gotten a bit tighter,
yeah,
but if you can manage that, awesome. And then areas where you have that discretionary spend, I like to call it the area of opportunity. That's where you can make sacrifices
yeah.
and accelerate achieving your financial goals, right? By bumping up how much you pay yourself first, right? So you might have to do short-term sacrifices to allow you to get to those longer-term goals that you have.
Yeah, and
So
here I would say there is a responsibility, being an accountant and you being an insurance advisor, to make them understand, that investment, that insurance is actually an investment, right? It's not an expense. Similarly, if you are buying a house, you are paying EMI, or equated monthly installments. That has two components. One is principal and one is the interest. So interest is an expense, whereas the principal is home equity you are building. So that should be classified as a savings slash investment bucket. So, and insurance, whatever people are going to invest, it should be treated as savings slash insure. Again, you can debate that there is a mortality cost in some insurance, which may be a kind of, there are asset management expenses, which are kind of gray area, whether it is
yeah,
a real investment or expense, but the bulk or part of it is actually investment. Yeah,
yeah. And that's, I like that you said that. How do you view insurance, right? Because it
yeah,
is a financial tool that you can use in various aspects of your life and also your business. Some people don't know that insurance can actually be part of your cash management or credit management strategy, right? And they
yeah,
don't know that it can be an asset that you can leverage. So thank you for pointing that out. It's just a change of perspective and how
yeah.
you use that tool, right, to make it an asset for you. And then the other question that I have, right, what are some of the long-term effects of poor credit management? What can be the fallouts if we don't pay attention?
Okay, before we get to that, if you don't mind, can we take a quick joke for of the moment? Yeah. So I have a question for you. Why don't sharks attack bankers?
Hmm, why don't sharks attack bankers? You know what? You tell me.
Okay, so professional courtesy, right? They both know how to handle debt.
Okay.
Yeah,
Well, yes, and I believe that is true, right? But
yeah.
different forms of debt. It's spelled differently. Oh goodness. All right. So the question: what are some of the fallouts if we don't manage our credit properly?
Sure. So I would start with the obvious, of course, increased cost of borrowing, right? If you are if your credit score is low, so your interest cost is high, right? It is inversely proportional to your credit score. You would not be eligible for borrowing from the tier one banks. You may have to go to tier two or tier three banks. There are additional charges. A lot of these mortgage agents may charge you over and above, which they call it as a one-time cost, right? So definitely it's going to be expensive. That's the first fallout. Second is, I would say, both from personal and business perspective, your relationships with suppliers, right? If you are not having good credit, that means your cash flows are not uh, you're not paying on time to your suppliers. So definitely they will not be happy, right? Third is if you are a business and you are thinking of, say, attracting investors, you are thinking of doing a Series A funding, or if you are a startup, or if you are thinking of exiting, people look at, like I said, Dun and Bradstreet credit report, your balance sheet, and that would reflect a lot of overdue, say, both debtors and creditors, which will not be treated, in a good way for those potential investors. And last but not least is, your competitive edge, whether as a person or as in terms of more so in case of business, right, will be reduced. You would, in case of recession, there are chances that your business may not see the light of the day, or you would not be able to invest in innovation and other things that are really needed for you to be on top of everyone's mind. Yeah. Anything else you have to
Yes,
add?
and I know that these past few years have been challenging for individuals with the higher interest rates, the inflation, a bit of a recession, right? It has
Yeah.
put people, a bigger proportion of our population into a very credit, um, unfavorable credit position. So, what are some of the steps they can take in order to manage that situation? What can they do?
Well, that is not a good state to be in, right? Financial distress. But even after our best attempt, we may see ourselves in that situation. But happy to say there are still options available. I would say the first point is be honest and transparent with all your creditors. Explain them the challenge that you are going through. I'll just give you one example of a client just approaching me last week. They run garbage trucks, right, which picks up garbage. So they had two trucks, and one of them met with an accident, and because of which their business was, because they needed at least two to get the business for that particular municipality where they were servicing. So his entire business was just not running, and he was not able to pay his installments on time to the bank. And we were able to negotiate a proposal whereby the bank agreed for a moratorium. Moratorium means no payment for next 6 months. And also the repayment schedule was made more flexible. They were given an extra year. So if you are being honest and you come up with these things, and same is the case with CRA, right? If you have challenges, there is something called taxpayer relief program. If you are going through genuine challenges and you come up with that and disclose, there are chances that at least on the interest and penalty, you will get relief. And then I would like to touch upon two concepts of consumer proposal versus bankruptcy. Again, no one wants to go through that, but if you have situation where you have no other option of repaying all your debts, and then what does this situation look like, just for everyone to know? So I'll start with consumer proposal. So consumer proposal is something when you have an outstanding debt less than $250,000. So you can approach an insolvency trustee who will prepare a proposal. Majority of your creditors have to agree to that proposal. Say I have $100,000 due to all my creditors, and I'm only able to pay, say, 60,000, right? So I come up with that proposal, and if majority of my creditors agree on that, then that is what is going to be my repayment schedule for the next 4 to 5 years. Typically, that's
Okay.
the period through which a consumer proposal goes through. And what it does is, of course, you can still keep your assets, including if you are eligible for any tax refund, you will still get to that. The benefit is, of course, you are paying less than what you owe. And what it does to your credit score is important to know that it impacts your credit score, and that will continue 3 years after completing the entire payment. So in other words, if the consumer proposal continues for 4 to 5 years, your
Mhm.
credit score can go back only after, say, 7 or 8 years. Yeah.
Okay. So these are more like kind of last resort type
Yeah.
options for
Sorry, I will
individuals.
also take a minute to explain bankruptcy and how is it different from consumer proposal. So of course, no one wants to go through that, but if you have
Yeah.
debt, outstanding debt more than $250,000, then that's the only option you have, right? And what it does is, your all your assets are seized, and you have to appoint a trustee, a trustee gets appointed who takes care of all your assets, and those
Mhm.
would be disposed of, right? And here, unlike consumer proposal, the creditor's consent is not needed because the trustee will take care of all your assets, and whatever is the proceeds he's able to collect from that, that gets repaid to the creditor based on who has the first right over your estate, and then second one, and so on, right? So that's what
Okay.
happens. The good part is that it takes much small a lesser period, 9 to 21 months, but again, your credit score can only go back after 5 years from the end of this period. So give and take, it takes 6 to 7 years under both the options. Yeah.
Okay, so we have multiple options. Key takeaway:
Yeah.
communicate with your creditors to let them know what's going on with you so you can come up with alternative arrangements. We have two last resort options, which I guess with your help, they will do their best to avoid, right? And also looking at alternative ways of financing. And I'll get into that when I get to talking about how insurance can be used as a tool within your personal life
Yeah.
as well as your business life. Thank you so much for sharing all of those tips with us.
Great. So it's now my chance to ask you some questions, right, from your insurance background. Yeah, the first question that I had in mind is, what are the benefits of incorporating credit management strategies into overall financial planning for your clients?
Well, we've spoken about it quite a bit. It is very important to have a plan for your credit as well as any other element of your overall finances, right? And we mentioned just before that insurance, we should think about it as an asset that gives us more options when we're looking at managing our credit, right?
Yeah.
It's we think of it of addressing certain risks, but it's also an asset we can leverage to take advantage of other opportunities. When it comes to getting an insurance product, our credit score doesn't really factor much into it. But if you've had a bankruptcy or a consumer proposal, it might have implications when you're applying for certain types of coverages. How can it help in building out your credit management? When you use certain types of financial tools, example, a life insurance policy that allows you to build up cash value, you're actually giving yourself another credit option with
Yeah.
insurers, right? Because you can have policy loans And you can also use the asset that you're building to get collateral loans. So this is giving you another tool that you can use to help manage your credit. And the good thing about using insurance tools to help you manage your credit is that you basically kind of set the terms. You get to decide or customize your payment structure. The interest rates are typically lower than market rates. And also, it doesn't impact your credit score, nor is it even reported on your credit when you use policy loans. So just to put that out there, when looking into managing your credit, give yourselves all the options available. Options
No,
available
that's
with
great.
banks.
Yeah, sorry, sorry to interrupt. I was just attending your another webinar on mindfulness earlier when the coach was talking about peace of mind, right? So I always think that if you plan for a disaster, right, and insurance is that product, right? Basically you are planning for that disaster, and knock on wood, hopefully that disaster never strikes. But if it happens, you are prepared, so you are not panicking, and it is also a very good investment product, right? A lot of people don't realize that there is also a lot of tax optimization strategy that is possible with insurance, estate planning, right? All of those are wonderful solution that customers and clients can take advantage of. Yeah.
Yes, and both corporate clients as well as individual clients. The same products can offer businesses and individuals that kind of financial security, right? And it's good to have conversations with individuals who know about these options and how to use them in order to implement them for yourself. Because a part of credit management is having strategies or contingencies in place to ensure that if certain unfortunate events happen, you have the wherewithal to bring you
Yeah.
through those events.
Great. It brings me to the second question, that how can insurance products help mitigate risks?
Right. And again, insurance, whichever type of insurance, is basically in the business of mitigating risk, right? And for the insurance field that I work in, is basically mitigating the risk of loss of income mainly, and also unfortunate events that might happen to you personally. So, for example, income protection. If one person passes within a household, we know, especially here in Canada, you need a two-income household, right, to help your family survive. And similarly, if it's a business and they have co-owners, they all play a role inside of that business. And passing can also have implications for that business. And that can help, life insurance can help mitigate that risk, that exposure, right?
Yeah.
If we use the tool to create an asset, right, it actually provides, as I said, another source of funds to help you as a buffer against those curveballs that life throws at you, whether it's a period of
Yeah.
unemployment. If you have cash value in your policy, you can leverage it for a policy loan where it's unstructured repayment, so you don't have to repay it until when you get a job, right? So you have that kind of
Yeah.
a flexibility. And of course, the other products that are available, if you get ill, right? For seriously ill, we know that recovery and treatment can take a long time, right? Similarly,
Hmm.
if you get hit by a car or you're in a serious accident, recovery does take a long time. And for most individuals, when you can't show up for work, you don't get paid. Or when you can't show up in your company, the company loses revenue. So you have to
Yeah.
have another source of funds, which would be that lump sum payout from a critical illness policy or the monthly income substitution from a disability policy. So whether you're a breadwinner in your household or a entrepreneur, you have to use these products to look out for the people who depend on you, whether it be your employees or your family.
No, excellent. Yeah, these are really very useful advice, and I hope our audience is hearing and have taken care of that by taking adequate coverage.
Yeah.
Okay.
And the
Yeah.
risk too of not putting these tools in play for you is that one, you'll deplete your savings and you might be forced into a high debt situation just to keep your family going or your business going that you might fight, as we talked about before, to get out of, right? It's a bit
Mhm.
hard once you've created that debt snowball for yourself to stop it. So
Yeah.
avoid it by putting these tools in place to kind of protect you, be a contingency plan for you and your business.
Great. Okay. The next question that comes to my mind is, are there any specific insurance products that are more suitable for individuals or businesses?
Well, the spectrum that I mentioned before, right? Life insurance, critical illness, disability, these are available for both businesses and individuals. They might be used in different ways. Like, for example, for a business, it might be in instances business continuity and succession planning, right? Whether they're looking to protect against the risk of having losing a key employee to death or disability, having stuff in place to ensure that if something happens to one of the owners, the corporate debts are covered, right? Because as business owners, when we take out debt, right, in our business names, we most often than not have to give personal guarantees. And if
Yeah.
one of the owners pass, that could lead to the debt being called or debt being restricted. If you're an individual and you say I have a mortgage and you don't have one of the co-signers on a mortgage pass, the bank might choose to call it, right? So the same product, life insurance, can be a tool to use to mitigate that kind of a risk. So it can be used for both personal and business. Most businesses, I'm sure you've seen probably their shareholders agreement, right? The buy sell clause. How do you fund that buy sell clause? If one of the owners wants to leave or pass or becomes disabled, how would you buy out their portion of the business, right?
Hmm.
So insurance is a tool for that too. Tax minimization, right?
Hmm.
Insurance is a tool for that too. And
Yes,
as
that's a great point. And since you touched upon the tax optimization strategy, I will share two insurance policies that a lot of my clients take, or at least I suggest to them, which is more for business owners. One is corporate owned life insurance, right?
yeah,
COLI, where it is taken on the life of the business owner. The good
mm-hmm,
news is the premiums are tax deductible. The
mm,
entire growth that happens in the investment is tax deferred. You have the cash value getting accumulated, which you can use for as a collateral or a loan. And if you have to withdraw, those are also are tax deferred. So a great tool. That one is one. And the second one I want to talk about is individual pension plan, IPP, which is again a defined benefit based insurance,
mm-hmm,
unlike most of the other insurance products which are on defined contribution. Again, the contribution is tax deductible for the corporation. The growth is tax deferred, and it also has the creditor protection, right?
yeah,
So like
mm-hmm,
we were talking earlier, if you are going through a consumer particularly bankruptcy, where all your assets are taken care of by the trustee, but not this one, right? Yeah,
yeah.
yeah,
And that's if a preferred beneficiary is named, it gives you that creditor protection. So that would be your
yeah,
spouse, your kids. Those are preferred beneficiaries. And I like that how you pointed out how companies can use the cash value,
yeah,
right? Because it
yeah.
is like, I call it an opportunity fund, right? So, for
Perfect.
example, you have an opportunity that pops up instead of having to delay um, ha- pursuing that opportunity because you have to present 2 years of T1s or T2s, do that income verification, whatever you need to do with a bank, with an insurance company. It's within your insurance contract that you can leverage that cash value for a policy loan, no questions asked, right? So it is
Yeah,
an opportunity fund for businesses as well as individuals. The other thing I
excellent.
think, Mhm.
Yeah, no, I know we have limited time,
Yeah.
so let's go to the last question that I had on this section, which was on what advice would you give give to someone who is trying to balance the debt repayment with the need for adequate insurance coverage. Yeah.
Well, just before we get to that, I wanted to point out two other things that I think is very important for business owners to think about when they are looking at coverage, right? One, a lot of business owners I find they don't think about their retirement. They're okay with doing the grind, right? But they don't think about what's going to happen when they exit the business. How are they going to fund their lifestyle? And insurance is also a tool that you can use to create a retirement fund. And you mentioned a story with a person who had a situation where they weren't able to meet a customer requirement because of an issue with a truck, right? It's the same thing that
Yeah.
happens when you have an issue with your physical self, right? Whether it's illness or disability, you can get business overhead coverage to ensure that even while you're not able to earn, your contractual expenses are being met. Your loan repayments, your utilities, your admin staff, all of those can be covered with business overhead expense insurance. So just those additional tools to bear in mind when you are looking at risk and using it insurance as a strategy to mitigate that risk.
Sure, and to me, it is like must to have for most of the businesses, right? And a lot of that the falls on our shoulders in terms of educating the business owner that this is not something good to have, but must to have. Yeah,
Yes, a must to have. Yeah. And
yeah,
the survival of any business too is reliant on their teams. If you have a team
yeah,
with three or more persons, consider getting health and dental coverage, right? Because
yeah,
having that kind of insurance protects you as the owner as well as your teammates, and it actually reduces some overheads, for example, retraining and recruiting.
yeah.
So again, that's how insurance can support business owners as well as individuals.
No, excellent strategies. Yeah. Okay.
So, what was your last question? Remind me.
Yeah, that was on how to balance the debt repayment with the need for adequate insurance coverage.
Oh, okay. So, some people like to choose one or the other. But in my mind, you need both, right? And especially if you find it hard to meet your debt repayments, it's actually a signal that you do need to have insurance in place. Because for those that you would leave behind, should something happen to you, they'll be left with that burden, right?
Yeah,
So ensure that you are taking care of both. And there are affordable insurance options that can help you to have that kind of protection even on a budget. So
yeah,
don't avoid asking the question of your professional, right? Ask them to see what options are available to you on your tight budget, and you can get coverage for your family and also your debt repayment should something happen in the short term. But there are also, for example, a term policy. It's
yeah.
typically inexpensive, right? And some of them are renewable and convertible. So when you're back on your
Mm.
feet or more in a better financial position, you can choose then to use convert it to a permanent option with the cash value component.
Yeah, and if your finances allow, I like that return of premium option, like most of the policies have. So then it's an investment, right? Even you will be able to get back most of the premium that you have paid,
Mhm.
along with the growth that has happened over the years. So that's a really good strategy as well, right? You can have insurance along with investment.
Yeah. So, how do you think both our professions can work to ensure that our clients are using or have good credit management in place and they're on a good path financially to achieving their goals?
Yeah, it means like I think we touched upon it few times that we are solving, like it is two sides of the same coin, right? On one hand, you have debt and credit, which is something which you get into, if you are not being financially prudent, but insurance takes care of the things which are outside your control. So
Mhm.
definitely you want to be on top of both. You want to control what is within your control, and then take insurance for things which are outside your control. That way, you are having best of both worlds, right?
Yeah. And it's also to remember that insurance is a tool that can help you get to your goals faster with the
Yeah.
ability to grow your wealth tax efficiently and also to leverage an asset without tax consequences, right? And also, it's a wealth transfer tool. So I think us both, your accountant and your insurance advisor, needs to be on the same page so they're both moving towards the goal,
Yeah.
right?
Yeah. Yeah, means I would suggest the client should have a joint meeting with both so that all three stakeholders are on the same page, and I'm sure that will be a win-win for everyone. Okay, what do you think are some key strategies for protecting financial stability during economic downturn, especially in relation to credit and insurance?
Well, definitely review your insurance coverage, right? To ensure that it's adequate, right? So you mitigate any exposure that you have to the best of your ability, right? You make use of the tax advantage tools that you have to ensure that taxes aren't taking too much of your dollar, right? You're keeping more. And I do love the rule that you had before, the 60-20-20 rule. So if we can keep those rules in play even during challenging times, right? Having those spending rules to ensure that we are sticking to our budget and we're still achieving our goals. Those are some tips that I would give. How about at your end?
I would say having a healthy emergency fund is very helpful so that if any disaster strikes, and that should be at least equivalent to 6 months recurring expenses, right? Try to keep your credit utilization within 30% of your overall limit. That will help to boost your credit score, like we discussed earlier. Yeah, diversifying income, yeah, it is very helpful as well. Yeah,
Yeah. And just also remember that your insurance is also a tool to protect your assets, right? Especially if
yeah.
you have dependents like kids and a spouse that you have to look out for. Stashing cash inside of your insurance policy is a good idea, right? So
Mhm.
think about how much you can put there to achieve your goals and to protect your family.
Great.
So when you're talking about businesses, how can they leverage both our services as accountants and insurance?
Most accountants can help with the financial planning piece, whereas insurance can take care of all the unforeseen events, right? So eventually both are important, and an integrated financial planning is the way to go. Yeah.
Yeah. And I find that I think of life insurance, especially when using it as an investment or a cash warehouse, a wealth warehouse as well, right? It's having your cake and eating it too. It's an asset
Yeah.
that you're creating, right? And it's an asset that you are able to leverage. So what that means, it's doing multiple jobs. So any tool that can do that, add it to your toolbox, right? And the thing is, with insurance, you give $1, but you get 100, right? So the impact on your estate um, for risk protection is quite significant. There's only so much you can do with the cash in your pocket. Putting $1 of it to insurance does magnify what you're able to do for your business and your family.
Yeah, it reminds me of an insurance policy. Their tagline was, it is with you while you are alive and even with you while you are not alive, right? So something like that, like best
Yeah,
of both worlds. Yeah,
yeah. Mhm.
yeah. What are the consequences of ignoring credit issues where professionals like us can help?
Well, we've been through the consequences. It's basically you're going to be caught up in that debt snowball, right? So it's
Yeah.
always better to be proactive. Reach out to Abby if you have a question about managing your cash flow, getting your financing in order. Maybe you need somebody else to look at it from a bird's eye view perspective to see what you can't see, right? And then reach out to me if you want to make sure that if something goes wrong, you are covered. Or if there's an opportunity, you have access, quick access to liquidity. So we can help, right? And
Yeah.
now you know, and you cannot unknow these things. So put these tools to work for you.
Great.
So tell me, Addie, what kind of efforts do you have in place to help your clients or potential clients learn more about managing their credit and getting on track when it comes to their finances? What can you offer?
Well, this is what we are doing, right? Doing a webinar and hopefully it reaches out to many people, particularly the ones who really need to know the nuances of having good credit while also having the right insurance coverage, right? So we can, I act as mentor to like various incubators, and sometimes I do those workshops, and I would be happy to do similar webinars more often so that we can create that awareness, right? I'm passionate about spreading financial literacy, so definitely it's something very close to my heart. And we should encourage our clients to do their own credit check. Maybe I'm thinking like a self-assessment tool. We can share something, some questions, right? 10 questions, and which people can answer based on their situation. And then it comes up with a score to tell them that, oh, out of 100, you are at 60. That means, a lot needs to be is desirable, and you need to maybe reach out to professionals for guidance and support. Yeah. Because, like we have been discussing for last 1 hour, that this is now not something which is good to have. It can really derail your personal finance, and it can derail your peace of mind, and your entire family can be at risk if you are not taking the right decision at right time. Yeah.
Yes. And as I said before, and I can't say it enough, be proactive. If you're starting a company and you're drafting your shareholders agreement, that is the point at which you start to need making these kinds of decisions, putting insurance policies in place, right? Especially if you are the breadwinner of your household and maybe your partner is staying at home, they're not really earning an income. Imagine what would happen to them if you didn't have these safeguards in place. As Abby said, we are here to help you with your financial education. I do this on a weekly basis with my lives, my webinars. The goal is to help you, right? To help you learn, to help you become aware of the tools that you can use to build your business, to protect your family, to grow your wealth. So reach out to professionals like ourselves, a consult with myself, a free insurance assessment. It, as I said, free, right? There's no obligation. But the thing is, you will leave knowing even more about your financial situation, and that can help you take action.
Yeah, the same thing is applicable with me as well. If you want to get like I have a tracker on financial health of an individual or a business, feel free to go through that. And yeah, that will tell you how much water you are in and what kind of challenges are ahead of you, so that you can be proactive and you don't wait till the end, right? And I would like to end that debt is like a friend who always wants to hang out with you but then never leaves. So manage it well, otherwise it shall overstay. So it's such kind of a friend with whom we have to be exercise some element of caution. Yeah.
Yeah, definitely. Do your best to kick it out of your house, right?
Yeah.
Yeah. And my ending thought is that financial planning is a process, right? It's not an end in itself. So this is something that you need to look at on a regular basis, consult with the professionals in your life on a regular basis, stay on top of it, right? So, Addie, how can individuals watching this live or on the replay reach out to you?
I think my phone number and email ID is being shared. So that's one. I also have a YouTube channel called Money and Mine at the rate Abby Lahiri. So you can connect me there. I'm also on LinkedIn. My name is Abhijit Lahiri, and I post a lot of useful content on a daily basis. So you can see and follow me there. So yeah, there are lots of ways to be in touch. Yeah.
Yeah. And you know what? I have a feeling this is not the last time we'll be having a conversation. So, you know
I'm
what? Look out
sure.
for
Yeah.
more. Look out for more from both of us. And I also have my YouTube channel, Money Matters with Dean. So this will be posted there as well. So if you want to listen later, check it out. Thank you so much for listening and have a good night.
Thank you. Take care. Bye.